So good afternoon, everyone. I'm Luke Mandikich from Channel Capital. Welcome to our global market update with our government bond specialist, Jamieson Coote Bonds. I'm pleased to be joined today by Charlie Jamieson, Chief Investment Officer at JCB for our first webinar of the year. It's hard to believe that we're already approaching the end of March. Feels like we've had pretty much a turbocharged start to the year, and bond markets have been front and center once again for investors. So no surprises to see so many people on the call today. Just in terms of the agenda for today, we're going to try and I'll just get Matt to bring up the disclaimer slide while I'm speaking to keep my compliance colleagues happy. So just in terms of the agenda for today, we're going to try and lift the hood on some of the major topics that market participants have really been grappling with in recent months. So some points including expectations around the shape and strength of the recovery, some of the recent movements in yield curves and the flow-on effects there, inflation expectations, both for the short and medium term, and then the role of fixed income in portfolios looking forward. So no shortage of talking points at the moment, which should set us up for a really interesting discussion. As always, we'll leave plenty of time for Q&A with the audience at the end. And thanks to those of you who have pre-submitted some questions ahead of the call. For everyone else, you can ask a question at any time during the presentation, just using the Q&A tool in Zoom, which I'm sure you're all very familiar with by now. Just very briefly, for those of you that haven't met Charlie before, Charlie is the CIO at JCB, based here in Melbourne. He spent his entire career in bond markets. Previously was the head of fixed income currencies and commodities at Bank of America Merrill Lynch. Charlie's one of the very few duration specialists in Australia. He has more than 20 years of experience, having managed portfolios through a range of crises and interest rate cycles, which has proven particularly valuable once again over the last 12 months with all of the volatility that we've seen. So thanks for joining us today, Charlie. Okay, all right. So to kick things off, I guess starting at a sort of high level, the current economic recovery, it's been fairly challenging to navigate. How have you seen this recovery compared to some of the previous economic cycles, Charlie? And what are some of the key differences in your view?
Thanks, Luke. Look, the recovery is patchy, I guess. There's no question that it has occurred in certain parts of the economy, like property, for instance. It's incredibly buoyant, but other parts of the economy, not so much. So I think it's fascinating to just kind of reflect on how fast this has all occurred. I think the one big difference in this kind of crisis has just been the lightning speed at which everything has happened from a market's point of view, be that, what we went through last March and April, and then the pace of the recovery once the government's, dived headfirst in, and obviously the central banks, through the kitchen sink at holding back the tide of risk. And they did a really good job, and they've done in some respects too good a job. And so I guess, as we kind of look forward, it's interesting to kind of look at all of this and consider, where are we now? We know that we're basically to the day about to wind down JobKeeper, which is going to be fascinating to see what happens in Australia. Does that optimism and news flow turn to, layoffs and clearly, some joblessness, which we would expect to occur today, with Brisbane being locked down tonight. We're reminded that the crisis is not an emergency anymore. It's not we don't have to worry about 10% of the global population dying like we did maybe this time last year. It's manageable, but it's still here, absolutely still here. And certainly as we're coming to winter in Australia, and we've avoided it, through the light, bright summer, we've seen everywhere else in the world that have suffered tremendously with COVID problems through their own winters. So that's something else that we need to kind of consider. But I just think it's going to be very interesting to look at the evolution of the recovery once the governments who've become so entwined in economies actually try and stand back a little bit. I guess if we hold the mirror up to, the moves of last year, once the governments dived into the market and provided that bridge of cash flow that was desperately needed, the markets absolutely loved it because the quality there is absolute and guaranteed. clearly, as they start to step back, and the irony to the risk market is the recovery in and of itself could be a little dangerous for risk pricing. Then the private sector is asked to step forward and stand on its own 2 feet, and we just don't know that there is huge animal spirit from the private sector to do that. We don't expect that there is, and so we've got to expect that it'll remain patchy. And I think you're seeing that kind of play out in some of the volatilities that are occurring in markets over the course of this year. Certainly none more so than the bond market, which has experienced tremendous volatility, particularly in that month of February. So yeah, we think that there's still a lot to monitor. Broadly, it's great that we are recovering, but we're a long way from a 2019 type economy. And central bankers just continuously remind us of that. As much as there is optimism, for vaccination and all these types of things and some normalization, we're still very much in this kind of stop, start, stop environment. It makes it really challenging to plan, and it means that the economic data remains much bumpier than we would otherwise be normal to.
Yeah, and so you touched on the volatility that we saw in bond markets in February. I guess it's no secret that bond yields globally have risen dramatically in the first quarter of the year, and to a large extent, I think Australia's been leading the charge in that respect. What's driving these moves, Charlie, and how sustainable is the shift? Maybe if you want to walk us through that and then some of the second and third order implications of the moves in bond yields.
Yeah, we wrote a much longer monthly in February because we thought it was really important to flag this for folks, that volatility in the risk-free asset class doesn't stay in the risk-free asset class for very long. It tends to jump into other asset classes, but it's certainly, these are the front seats on the bus. And so you can get a little bit of a jump on things if you watch this space, because it's tremendously important. I was joking with a friend of mine who read my monthly about the virus that affects all things. And he was saying to me, did you just make that up after COVID? And I said, no, we used to write about that, all the way through 2016, 17, 18, particularly when we're talking about the US Fed raising rates and how, there is a point at which the interest rate risk really matters because we price so many other asset classes off it. Clearly, with regard to this year, the Democrats taking the Georgia Senate seats early in January gave the Democrats a path to use this reconciliation process in the Senate to pass extraordinary stimulus, and to kind of 10% of 10% of GDP for the US economy right now, which is doing okay, is quite an extraordinary injection, and certainly going to get things pretty turbocharged in the very short term. But then, of course, there is a bit of a fiscal cliff thereafter that needs to be managed. But bond yields certainly, there is rising inflation expectation. It's absolutely no secret that inflation will definitely rise by virtue of the base effect alone. Remembering that this time last year, we'd shut down in China, or the lockdown started in China, moved to Italy, and then it just went global. We were globally locked down. So, the use and need for oil collapsed. And folks that were long short-dated oil contracts didn't want to take physical delivery because it was very difficult to store. And we had this extraordinary period where we had negative oil prices. I will pay you to take the oil away. And clearly that was tremendously deflationary at the time in terms of the near-term inflation data. And so as we're dropping that data now in the year-on-year calculations and putting in 2021 data, then inflation must mechanically steepen and rise tremendously. Now, we're actually writing a white paper on this at the moment called Over the Inflation Hill, because as that base effect ramps up, it flatlines and then falls away, with kind of equal pace through time. And so we want to look at that and say, well, yes, I can, there's definitely sympathy as to why yields have risen, but how sustainable is that? We know that there is inflation expectation from other things too, like supply blockages. We've got the Suez Canal jammed at the moment. That's causing havoc in terms of global shipping. So there's going to be a little bit more of that around. And we saw a lot of that after the GFC. But these one-off supply shocks, they clear as well. And so we kind of consider that there is an awful lot that is relatively transitory. And so certainly central bankers have been reminding us again and again and again, yes, inflation's going to rise. It's transitory. We're going to look through it. We've moved to average inflation targeting. We don't need to immediately respond, because the last thing we want to do is choke off the recovery by raising interest rates too early. And so they've really doubled down with their commitment to keep funding rates very low. But the sell-off for February really started, I guess, in moving to that higher inflation expectation and seeing the size of this fiscal package from the US. It was passed at 1.9 trillion. That's a hell of a lot of bonds to issue. And so ordinarily you'd think that the US would be the big mover and other markets might move in sympathy, but that wasn't the case. Australia was the biggest underperformer, which is a really big surprise because the RBA had moved to doubling down on QE, which takes us into what we call negative net supply. And negative net supply essentially means that the RBA will be buying a lot more bonds than the government will be issuing, therefore forcibly changing the demand and supply equation. But it was actually Australia that had a really big underperformance. We thought that looked really manipulated at the end of the month. And so, there was a hell of a sell-off in the last 20 minutes of February, and then it bounced straight back. And it was a bit of an overreaction in many respects. And so far this month, there has been a pretty good bounce back. But notwithstanding, the market's selling off because the economies are healing, because this inflation will come and it will last for a little while. A lot of it can be looked through, but that doesn't mean it's not going to change pricing. But then, the magnitude of these sell-offs really matters. It really matters for credit markets. Credit markets, of course, being the oil that plumbs the entire financial machine. And then, of course, it can flow through to equity markets. And so we just remind folks that when we last had a sell-off like this in 2018, was in the fourth quarter of that year. The Federal Reserve started the bond market sell-off by saying they were going to move, they were a long way from neutral rate of interest, and they were likely to exceed it. And the Treasury market had a similar size sell-off to what it experienced over February and March. Nothing really happened. It was in October of that year. And then in November, the credit markets seized up and there was no debt capital markets high yield issuance for a period of about 5 weeks. And of course, in those markets, there are a lot of zombie corporations that simply can't pay their interest from free cash flow. And they absolutely require the ability to constantly roll forward their debt obligations. And they need those high yield markets in particular in order to do that. And then equities noticed, and we had this tremendous downdraft in December of that year, about 20%, which actually forced the Fed's hand, and they came out and said they'd moved to neutral, which they did on the 4th of January in 2019. And they were cutting rates 7 months later. So, we just remind folks that this is really important. I don't think we've seen the end of interest rate volatility by any means. After a really calm and quiet period in the back part of last year, after the initial shock this time last year, we did have a pretty docile environment for a while there. But once the volatility genie gets out of the bottle, it doesn't go back in easily, and it can often spread to other things. So we just really want to highlight that for folks because we think that this is a really important evolution. And should it continue, it's calmed down for now, then that can certainly have a big impact on other things. Of course, if it does have a big impact on other things, you end up getting a flight to quality bid back into the bond market as other things are in decay. And so you'll well remember, despite the sell-off of Q4 2018, government bonds were the best performing asset class of the year by the end of the year. So these things can flip around quickly. And I guess the thing that we really notice in markets, and we've certainly experienced in this market, is just the fragility of modern day markets. That all observable prices have looked really good for a lot of asset classes. But once you go and try and put a lot of volume through those prices, the markets that are very algorithmically run these days tend to fall away very quickly. And so if there is a change in news flow or virus evolution or policy, if policy is withdrawn and we don't have this constant stimulus, I think we can expect things can change very, very quickly. And it's very hard to get set in terms of risk profiles after the fact. The speeds are just lightning quick. You've really got to be well set up and have a good strategy going into those moments.
Yeah, so I mean, you touched on some of the flow-on impacts of higher bond yields for other asset classes, and 2018 was a great example of what we've seen in the past. To date, we've seen a big steepening in yield curves, but I guess that the Nasdaq has wobbled slightly, but we haven't really seen a big correction yet. Is your view that's still yet to come, Charlie, or have we kind of seen, or we're going to see at this point?
I think we were starting to see that, definitely, but the stimulus checks actually arrived last week. And so there's probably a lot of sponsorship for risk markets. We know that lots of folks on Robinhood and the like have run straight to the market and invested because it's just free money, right? You can't lose. Well, clearly, I mean, if that flow goes through the market, it's tremendously large, and it's probably changing and frustrating things a little bit with regard to what would have otherwise evolved. It's funny, though, when you stand back and actually look at where we are versus the narrative that we're kind of constantly fed via 24-hour news media, things aren't actually maybe as robust as we think. So if we look at assets like the currency in Australia is lower on the year, then that's not really kind of in line with the unbridled optimism that we see. The commodity complex is really strong. Global reflation is happening. How can the currency be lower on the year? Some parts of the bond market are not performing as you're probably hearing in the media. So the long end of the US Treasury yield curve is actually flatter on the year. And as much as you just hear constantly about yield curve steepness, and we're looking at that chart in Australia now, and yield curve steepness really matters. But it's important to remember the way that a bond market sells off. And we're going to write about this in this big white paper that we're writing, to look at how the total return damage can occur and where it occurs. Normally, it doesn't all happen in 1 month. Certainly, that's got everybody's head spinning in the bond market, the speed at which the sell-off occurred. But the sell-off definitely starts in the long end, in the longer bonds, the longer duration instruments. And that's where the total return damage is most severe. And that's driven by inflation expectation. After that sell-off occurs, we get to this period where bonds actually become somewhat investable. It's probably not perfectly optimized. And we'll take you through the maths of that in a minute. But then the sell-off moves into what the intermediate part of the term structure, into the kind of 5 and 10-year part of the term structure. And that's broadly what we're seeing in the US Treasury market now, which is why those really long-dated bond curves are actually flattening as much as the whole thing is primarily steepening. The long end becomes really sticky. The really long end becomes sticky because there's lots of asset liability matches that like much higher yields. So, thinking in Australia, if you can buy 30-year continuously compounding bonds, at 2.8%, 2.9%, that becomes pretty attractive if you believe that the reversal rate at which, if the RBA was to hike interest rates, they'd crush the economy, can't get too far beyond that. And there's some inflation compensation. Clearly, if the RBA stick to their guns, and so the reason that the last part of the sell-off is right down the front end where the actual funding rates occur, when that occurs, the reason the curve flattens is because you're crushing future inflation expectations by raising rates. And so it's actually all pretty kind of logical if you think that through. For those of you that have known me for a little bit longer, you'll remember me waxing lyrical about why bonds would be fully investable through the Fed hiking cycle of 2016, 2017, 2018. Everybody said, well, rates are rising, surely that's bad for bonds. It really matters which rates are rising. And if 1-year rates are rising, it doesn't really matter much to a bond investor. If 30-year rates are rising, it matters tremendously. And so we've broadly been through that now. And so this is where we're kind of getting a lot of interest from our current clients, most of whom are underweight duration and have been for a little while. And they're kind of thinking through, well, what comes next? When might I get invested? When would I consider coming up to a neutral? Dare say anybody ever going overweight this asset class? We've never really had that on our journey. And fair enough too. I mean, yields are much lower than they used to be. But what we're looking at here is the major sell-offs over the last 30 odd years. And this has been a pretty big one so far. And what we're kind of seeing, clearly, it's a little unfair to compare against, periods like 1994 because rates were just so much higher then. But what we're seeing here is a trend in the way that, these sell-offs evolve and what comes next. And what you'll note is that the market, as you can see here, that the size of the sell-off, so in 94, 434 basis points, it doesn't need to re-rally very far to generate material outperformance. And you'll see that consistently all the way through that table. And the reason for that is that when the sell-off occurs, not only are you re-establishing the yield, which is very, very helpful for forward performance, makes the asset class much more defensive for future risk episodes, but generally you're resetting the steepness of the curve. And that just becomes so tremendously important if you think about the way that performance is actually accrued through an accretive fashion over time. Might just get you to come forward a couple of slides, Matt, to the carry and roll, because this is pretty fascinating. And I've kind of written about this a little bit lately, and I've been talking about it a lot because it was surprising even to me until we went and did the maths to say, over the last decade, everybody knows bonds have done pretty well. And why have they done well? Well, everybody, including myself, before we did the maths on this would have said, well, duration's been a huge contributor. And that's, of course, true, but it is not the majority of the story. The majority is definitely carry, i.e. yield. and roll, i.e. the steepness of the curve. And we know that we're at a point now where, the curve in Australia hasn't been this steep since the early 1990s. This is really, really reset. It's like a rubber band getting pulled back. And it's just a tremendously powerful concept. So for those folks that don't know a lot about bond markets, the roll in very simple terms is the bond moving down the term structure curve. So to keep the maths really easy to follow, if you buy a 5-year bond that yields 50 basis points at the moment, we have a yield curve control in Australia so that the 3-year point yields 10. If that 50 basis point 5-year bond, you own it for a year, clearly it becomes a 4-year bond. Over that time, expect that it's going to yield around about 30. It's going to surf down the curve because in another year's time, when it becomes a 3-year bond, it's going to yield 10. And in that process, essentially, there is a capital accretion. So not only are you getting paid the yield that you earn when you buy the security, 50 basis points, which is locked in as you purchase the security, but you get this capital accretion as the bond surfs down the curve. And that is a tremendously powerful concept. It makes my job as a bond manager a hell of a lot easier. It makes us look a lot smarter than we really are, because there is just this implicit thing that is occurring all the time. It's this continuous compounding, which every day is working in your favor. Now, duration is the very obvious one. Clearly, episodes like February, you can see that it can change pricing very quickly. But over the course of time, once yields have materially reset and curves get steep enough, the go forward is tremendously attractive. Now, as I said, we might not be all the way there yet. We know that if we look at the way that the base effect happens in inflation data, inflation is likely to peak in the coming months. So it's certainly around about May to June, and we've highlighted all of this in our white paper, looking at the evolution of that base effect change and how it might occur. Is the bond market way out in front of this, and does the market start to perform into that kind of peak? Possibly. I can't answer that exactly. But certainly there is a point here at which things should calm down a lot, and this becomes pretty compelling on a go-forward basis. Because after that, of course, once we've got this huge sugar high from this enormous fiscal stimulus package, and governments are trying to step away from being deeply entwined in markets, what's over that inflation hill certainly looks a little different. We know that inflation starts to mechanically come down. We would expect that some of that supply blockage is cleared. And we certainly, we know that there's a lot of secular drivers of disinflationary outcomes, some of which have only increased in terms of, the pace of technology evolution or the huge amount of debt that's outstanding, those types of things. But in order to get secular medium to long-term inflation that's sticky, we need massive wages growth. And we're just unlikely to see that, given that they've got this huge spare capacities in economies. I mean, unemployment came down a lot here in the last data in Australia, which is encouraging, but that's a really bouncy series, and the ABS haven't done a lot to kind of change that. It tends to be pretty choppy. So we're really interested to think this through, to try and suggest an optimization window here where potentially defensive allocations can be rebuilt, because they are tremendously powerful. We spoke to a large group of investors with us recently who said, we said goodbye to you guys this time last year. It was wonderful to be able to get through the market very quickly. We didn't have any sell spread changes in our funds, so there was no soft gating like a lot of other funds. That's important because people forget, when you commingle sovereign government assets with corporate credit, if that corporate credit market jams up and seizes, as it does periodically, then the whole unit trust structure can be very compromised. And we certainly saw that in March and April of last year, which is why we've waxed lyrical about liquidity and why it's so important. But this group said, we said goodbye to you, which is the right thing to do in those moments. That's what we're kind of here for. And we said hello to equities, and we made 4.5 years of return in 1 year. And so now we're happy to say, to trim that back a little bit and start to rebuild these defensives. And I think if we take you kind of logically down this road as to, yes, this has occurred, it's happened much faster than I think all of us were expecting, but it has happened. And there is a pretty obvious kind of peak to the transitory base effect inflation that we can see. Then there is a pretty obvious pathway forward coming out of that, which looks kind of interesting.
Yeah, I just want to dig in a little bit on some of your comments there, Charlie. So you made some interesting points around the fact that we've seen long end yields rise a bit. So we've reset coupons higher. We've got these nice steep yield curves now. But on the other hand, absolute rates are still quite low, and volatility is, relatively high in bond markets and probably remains so for the foreseeable future, as you noted. So how does that play into the role of fixed income in a portfolio construction context? What's the role of bonds today in a portfolio? Do they still have the attributes that people traditionally think of bonds for, or has the landscape completely changed?
I think the landscape has completely changed. Certainly, the re-establishment of yield and steepness give them pretty good runway to run into if there is a material risk off. We know that the correlations move around, and at some periods, they can be positively correlated. What we can absolutely tell you is under severe stress, they continue to be very negatively correlated. And certainly even in markets that have been at negative yields, that's observable. So we wrote a lot about that around the German market, the Swiss market, the Japanese markets. So look, I fully appreciate that people feel that defensive role was diminished when yields were low. It changed a little bit, I think, but they still remained very liquid, and that's really important because it provides that wonderful portfolio optionality in those moments. But it's the combinations of which, I guess, if we just come forward one slide, please, again, Matt, and have a look at credit spreads. Yes, absolute yield levels are still very low, and absolute cash rates are still disgustingly low. But there's this massive challenge in income, everywhere. I guess credit spreads are incredibly tight. We know if we come forward again, one slide, Matt, that historically, credit doesn't love being down at these levels, and when it does bounce out of these levels, it tends to be somewhat chaotic. We've seen lots of episodes of that. I mean, that fourth quarter of 2018 was a good reminder. We saw it again at the start of last year. The re-establishment of risk-free yield is really important to consider in credit. And I'll just, again, give you a very simple example to try and highlight that. If we have two bonds, one being a corporate bond that yields 5.5% and a government bond that yields 5%, so let's pick a really good corporate like a BHP or something like that, then clearly, that differential is essentially the credit premium, the difference between the government guarantee and the corporate guarantee. And in that instance, it's 50 basis points. If the government bond yield goes to 1%, the spread doesn't stay at 50. It tightens a lot. And that's the sort of re-establishment of that, fractional pricing for the credit risk. So you can see that that's going to collapse materially because not only does it become very yieldy in the context of what else is available, but it's remarking to reflect that correct corporate risk. Flip that around and say, well, if the government bond yield rises massively, does the spread stay really tight? Well, traditionally it doesn't. I guess this is a different type of marketplace. We've got this enormous government fiscal program that's occurring at the moment in the US, which is certainly probably helping spreads and helping equity markets stay elevated. But we know that when that spread widening does occur, it tends to be somewhat chaotic at times. It doesn't often just widen a basis point a week and nicely move up a linear pathway. It tends to gap wider, stop trading for a while, and then restart trading when things calm down or when policy comes to support that environment. So, to answer your question, I think, bonds are still really important. I think it's important to consider the different types of fixed income. I think investors are really lucky to have lots of different offerings on the shelf now, whether it's in my world being that true defend and protect and that liquidity piece, whether it's in the mid-beta, in the corporate credit space, whether it's in high yield or private debt. And I'm sure, Luke, you have lots of conversations with folks about how to navigate all of those different parts of the fixed income allocation. But we, absolutely exist to provide alpha in our sleeve. We don't forever suggest to people they should have 100 cents of their fixed income portfolio with us necessarily, because there's some really good product out there. But that product is optimized at different points in the cycle. And so certainly, credit was a great investment if you managed to get into it in April last year. But it is back to incredibly tight levels where compensation is very low, and the reset can be very brutal. As we've just experienced in the risk-free world, I guess. But that's all behind us now. And so looking forward, I guess we believe that they do have a very good role to play. Cash rates are going to be hideously low for a long time. Dividends move around. I guess you're being asked to pay very high capital prices for those dividends at the moment. So it's a really challenging part of the whole landscape, and I'm sure advisors would agree. this income piece. But we just really got to kind of remind folks that we absolutely exist to be that fit for purpose type allocation, to defend against anything that might be unexpected or those kind of drawdown in risk moments. And when we get really steep curves and the re-establishment of yields, it makes it an awful lot easier to achieve. If we think about something like relationships of bond yields versus cash rates, they are incredibly cheap. So at the moment, Australia is about 2 standard deviations cheap to cash. That historical spread over the last 20 or 30 years is about 54 basis points. Of course, we have the cash rate at the moment very, very low here and unlikely to move. The RBA have told us again and again and again that they won't be moving the cash rate anytime soon. So once we get through this higher print in inflation, we reckon that it's going to be very highly investable, because that power of that steepness of the curve and that additional carry does come with a little bit of volatility, you're correct, but it should cycle around in some kind of range here as we establish that top, and then it can perform very well, as we can see from those 1 year on numbers when we were looking at the sell-offs previously.
Yeah, so I think that's a really good segue into the slide that's on the screen now. So just before we move into some Q&A with the audience, keen to maybe just pause here and get some of your thoughts on the current, how you're currently positioning and the portfolios and some of the recent performance. It's nice to see we have the full suite of strategies available now, from the long duration domestic and global strategies through to the absolute return dynamic alpha fund. So it's sort of a choose your own adventure almost suite of products, which is great to have.
Yeah, look, I guess we run 4 strategies essentially, or the global strategy is bifurcated into hedged and unhedged. Hedged and the domestic strategy, which most people would probably know, their flagship strategy, traditional bond product. And clearly, we exist to own the product. We like the product through time. The beta is very compelling over time. It's a self-correcting asset class, continuously compounding government rates. We reckon the go forward on that actually looks pretty good, notwithstanding it had a really nasty February, its worst in quite some time. The unhedged product clearly is an animal of volatility. It can really whip about, as people have experienced. It's tremendously powerful when it's working for you. It had teen returns through 2018 and 2019, and then did 24% into the middle of March last year. Whilst everything else was moving backwards at a huge rate of knots, it was leaping forward and hasn't done well since, obviously, as the currency has reflated tremendously. But the currency, as I said, is lower on the year, surprisingly. So that one, it can be a wonderful tail hedge type addition to a portfolio that's running a lot of risk. You don't need a lot of it to have a big impact. And then dynamic alpha is something that we've, I think, a lot of success with over the course of this year. It's got a very different volatility series. It doesn't run a lot of standing risk. So if a plane hits a building or there's an earthquake in Tokyo, it's not going to move a lot. It's not going to move much at all, actually. But it's just grinding forward to a total return outcome on very low volatility. And everybody has a different, need for these products, and a different combination of which they want to look at their fixed income. Some people are just happy with an income-only total return, and they're not looking for that negative correlation that can become ballast in a portfolio so that it can zig when other things are zagging. It really comes down to individual preference, and it's got to be kind of viewed in combination of what else is in a portfolio. Clearly, portfolios with a lot of risk in them probably need the more traditional type allocations to help balance out those outcomes through time, or to curtail the total portfolio volatility. So it's very interesting to kind of think that through. We're expecting pretty powerful flows for the bond market into quarter end. We know that there's a lot of rebalancing to occur. Again, to make things really simple, if a superannuation fund has a 70% equity, 30% fixed income asset allocation target, in periods like March of last year, when equity markets halve, that asset allocation flips from being 70% equity, 30% bonds, to 35% equity, 65% bonds. And so unsurprisingly, they tend to sell down the fixed income piece and buy a lot of equities to get that back up. We haven't really seen a lot of reallocation back the other way yet. And as equity markets have rallied, again, that throws the whole standing allocation out. But there is a lot of talk at the moment that there'll be very powerful quarter end rebalances by virtue of the bond market sell-off and broadly equity markets holding up pretty well. So we're running a little bit of extra duration at the moment. And as with the traditional products have had very good months. Dynamic Alpha is not running a lot of risk. It has some curve positions on and a little bit of cross-market position on. It's just grinding away. It's very much on process for what we do with it. But we do have, these big month-end extensions that come up at the end of the week. And so we'll be looking to reposition things again into that period of performance should it occur and get ready for what comes in April. April is a month of incredibly intense cash flows in Australian bonds. It's when the Australian government pays most of its coupons. So we need to think that through, but we are expecting a new big syndicated bond 10-year at some stage as well, which can take the steam out of bonds a little bit. So we need to navigate through all of that. But broadly, we're running a little bit of additional duration, a little bit of additional curve risk, but we'll probably be done with that by the end of the week.
Excellent. All right, thanks, Charlie. Well, we've got quite a few questions coming through, so I want to get to some of those. And interestingly, a few of them are sort of following similar themes. But we'll start with Graham. Has a great question here. So we all accept that short-term rates will be low until 2024, based on the RBA's own statements. But home buyers are massively borrowing to their limits at these low rates. Does this mean that the RBA must avoid a 2024 cliff and hold rates down even longer?
If the political will is not there to see things brutally repriced, then yes, absolutely. And I can almost perfectly assure you that there is not a lot of long-term things that are occurring these days. A lot of policy evolution seems to be very reactive rather than proactive. I guess New Zealand is changing the game a little bit in the way that it's proactively going after curtailing this type of speculation. But yeah, I mean, I think you can kind of see in every policy cycle that we've been through for the last 30 years, we just can't hike interest rates up to where they were in the previous cycle high. So we're plumbing new lows with what we've achieved in monetary policy. And every time we're flipping back up, we're not getting as high as where we were in the last cycle. And that's absolutely going to be the case here again, because the amount of leverage that people are strapping on makes them tremendously interest rate sensitive. And it wouldn't take a lot, in terms of RBA hikes to really put, some pretty nasty funding pressure on those that are very indebted. And that starts a doomish kind of feedback loop it just becomes a death spiral. So yeah, they need to be tremendously careful. I think you can expect that if there is, some rate hikes that occur, they would be borne out over a tremendously long period. I guess the good example of that is the way the Fed hiked over 16, 17, 18, very slow, and of course didn't get very far with it. And in the end, managed to blow things up a bit that they had to come in and cut very quickly thereafter. So we don't expect that rates will, sadly, ever really rise like anything like you would have experienced previously. I don't think the days of 5 or 6% term deposits are coming back anytime soon. I think it's very likely that rates will stay low for a long time. There is a huge amount of government debt that requires funding and constant servicing. And that becomes very, very problematic. We talk about escape velocity. You can't get rates up much because the whole system buckles on itself under the weight of its own funding burden. And it's just very difficult to get rates up under that pretense without having material problems. And there's no stomach for that, seemingly, by the powers that be.
Yeah, it's interesting because it's certainly not just household balance sheets that are stretched. There's a similar question here from Matt, asking whether or not the volume of debt held by sovereigns is also a limiting factor on rates moving higher, which you've sort of just alluded to now.
Yeah, look, it absolutely is. I mean, it's just, if you can manage your own currency, clearly we can go a long way further in that. And we've seen that in places like Japan, and we're starting to see that in places like the US. I think it's kind of important to remember that, what comes next in this, and Biden's already talking about this huge infrastructure package, but the funding sources are starting to change. Wants to start raising taxes and looking at going about it in a different way. I think they realize that there are actually limitations to how far we can go with this, and the sell-off that we've just experienced is probably a pretty salient reminder that they need to go carefully here, because things get very unruly very quickly if the risk-free rate rises. It's important to remember the risk-free rate will always clear. So everything else will recalibrate. But if we ask too much of bond markets, that can be tremendously problematic for other things. I think, there's lots of folks, and we're starting to see this discussion come in the US where, we're getting 10-year bond yields higher than the dividend yields on equity markets. Clearly, that's becoming a place where you can move to the sidelines and it's not punitive. If that does continue, you can see that there is a huge amount of financial capital that would move into that and would be, motivated for that to occur. Remember, of course, too, that the healing process from the GFC was to make government bonds uninvestable. So you want to push all the risk-free down to force people out into riskier assets. And in doing so, you set off a trigger of financial tourism, where people that used to own government bonds move out to corporate bonds. They dislodge all the old corporate bond owners who move to high yield. And as we go all the way down the story, we end up, with a lot of sponsorship for equity markets, emerging markets, markets that people wouldn't naturally invest in. If that risk-free rate is re-established, there's lots of capital that wants to come back the other way. Not everybody wants to be invested in those riskier asset classes if they can just get a solid return back in risk-free. And so I think that's something to also kind of remember, because there does become a point where the sponsorship becomes very powerful.
Great. So this is a question that came in pre the webinar. So I'm hoping that we've sort of covered some of these points already, but I want to give you another chance, Charlie, just to hammer home some of your primary thoughts here. So Ben asks, what's going on with the yield curve, and what does it mean for fixed income investing for JCB and advisors constructing portfolios?
Well, hopefully we've answered what's going on with the yield curve. It's certainly sold off from the long end initially. That's slowed down a lot now. We've seen, very good demand for those high yields. And so the sell-off is mutating now into that intermediate part of the curve. And that changes the total return outcomes quite materially. So again, folks that have been following us for a little while will well remember me screaming black and blue that bonds would be very investable through the Fed hiking cycle after we had the Trump sell-off in November 2016. So we had this kind of similar episode. It's listed up there as number 6 in the sell-off table. And it was a powerful sell-off in and of itself. But once you get those those longer ends up much higher, then the total return starts to work pretty well by virtue of the carry and roll through time. Now, the duration element will still have, be additive or slightly subtractive to that total return. But once those things are established, it becomes really very powerful. And of course, when we get to the end of that sell-off episode, it becomes really compelling to be invested. Certainly, if we look at historical examples, bonds have done very, very well after that. And so if you are looking at rebuilding, defensive allocations or coming up from underweight to neutral, then, we're coming into a window which looks pretty compelling and pretty attractive. Granted, absolute yields are not as high as they have been previously. I just don't think we're getting back to a world where you get 3 or 4% yielding bonds easily, because other things fall over in the process. And so, bonds get a flight to quality bid. If equity markets, become problematic, there are people that are going to want to exit and buy bonds, and that's what tends to cap the whole thing. Governments can't afford for yields to get that high, and so they'll switch to mechanical buying programs. It's called the twist, which we hear about. The Fed could utilize it if yields move too high. Essentially, what they do is they sell their very short-dated bonds and they buy longer-dated bonds to control the yield curve in that way.
Okay, so there's a few questions here on inflation, so I'll just try and distill them all into one. So the overarching theme seems to be around the fact that the steepening curve really looks like a signal of the market at least expecting an increase in inflation. There's obviously all the headwinds to inflation that you've spoken about that are still in play. What's the risk that has changed, and that we do move into a structurally inflationary environment from this point?
Well, the risk is not nothing, of course, but we know that it's important to acknowledge when we're going to hear so much about inflation in the next 6 to 12 months. Are we talking about inflation or reflation? They're quite different things. I think it's mainly reflation, which is, we have to acknowledge that that's bridled to the deflationary episode that we've been through. And we know that those numbers need to move much higher. We're going to get US inflation in the high 2s, if not with a brief period with a 3 handle on it, 3 something, before it falls away again. And there's a pathway that we've built in our inflation white paper, which we'll be releasing. I mean, it's about 60 pages white paper. So I fully appreciate if anyone's having trouble sleeping after the Easter holidays, they could probably read that and they'll get off to sleep pretty quick. But we'll surmise all the sections and make sure that we distill that down to smaller tidbits for those that don't want to go that journey. But yeah, there is a chance that it could stick around. I guess, we do expect that once we clear the supply shock inflation and the base effect falls out, that a lot of the impetus that we'll get in inflation in the next 6 to 12 months will disappear. As I said, we really need to get material employment occurring, and we need to get wage gains inside of that. And so for everybody on this call, go and ask your boss if you can have a 5% wage rise and see what he says. I'm tipping you're probably going to get the answer that will be no. That's not going to happen right now. But there are things that could make it mechanically occur. And so, the Biden administration has talked about a $15 minimum wage up from about $8. If that occurs, I mean, clearly it's going to be very inflationary. There's so many people in the US work in service sectors at minimum wage plus tips, so they get a material extension. I do think that would also trigger a lot of people being moved to the unemployment queue, though, because the uptake in one of our secular disinflationary forces is the automation and robotics evolution. And we know that these robots can just simply do so much. They can work 24 hours a day. They don't ever get sick or take holidays. If the cost of labour goes up materially, then I think that'll accelerate that trend. But yeah, it is possible, although not likely. And we'll really make a very strong argument for that, looking through all the different parts of the inflation complex in that paper.
Great. Okay, well, just one final question here, just around the long end of the yield curve, both locally and in the US. Is there a sort of an upper bound that you're looking at in terms of a level that you think might provide a bit of a ceiling to where yields can rise to, Charlie?
Yeah, I'll give you a fascinating piece of statistic again, which is just the maths following the last sell-off episode. So the really big sell-off that we had in fixed income in my career in 1994, I was still at school, but was the 2013 taper tantrum, violent sell-off in the long end. And so we mapped from here on, if we were to follow the evolution of that sell-off, it would mean that 10-year treasuries would have about 50 basis points still to go. So they'd rise from something like 1.6%, where they are currently, up to about 2.1. In that sell-off episode, the long part of the curve, the 10-year, 30-year point in the curve, started to flatten, as it's already started to do in this episode. As I said, that curve is already flatter on the year. If you invested today and the market went on to complete that sell-off took 11 months in totality and sold off another 50 basis points, you would have a positive return in a total return context of about 1.6%, which is fascinating. I mean, that is the power of the roll and carry and that long end flattening that kicks in. A lot of folks have estimated that 175 would be a trigger point in US 10s where equities would start to wobble. I think anything further than that, and they're really going to care. The thing that's probably thrown things out of whack a little bit with regards to the correlated movements has been this stimulus injection. It's come perfectly at the right time to mask over what we would have expected to be volatilities that would skip across. But I don't think that's over. I mean, I do think that that's a one-off injection into the risk complex, and we're not going to get it again easily or quickly. So once that does work through, what's on the other side looks more interesting to us. And as I said, the grand irony of all of this, having lived on the sustenance of governments being deeply intertwined in markets, is that if we do heal and we get better health outcomes in the Northern Hemisphere, vaccinations are occurring and there's good, inoculation with regard to that. The major danger to risk markets might actually be the healing of all of that and the government's withdrawal from that constant, emergency stimulus provision. We're not in an emergency environment anymore. They don't need to have emergency settings with some of these programs. And so certainly as they try to wind them down, what we've tended to see over time since the GFC is that in order to keep getting stimulus, you have to have these anti-risk episodes. When we peel back the curtain to the market and say central banks are stepping out, you're stepping in, the markets tend to hemorrhage. And so in the game theory of it, I think that these episodes will continue to occur because the markets like stimulus. They much prefer to have the governments in being that bridge, that cash flow provider, than out. And I think that, you've got to expect that there's no question in my mind that we're up for a relatively volatile year, and there will be some crescendo moments in that.
Right. Actually, there is one more question here that I want to get to. I know we sort of through the allotted time, but it's an interesting point. So the question is around the fact that we, as in JCB, have been somewhat critical of the RBA and the way that they've conducted their QE program, in particular the way they've focused on the 3-year point of the curve. The question is around whether or not that's a deliberate move by the RBA and whether they're happy to see the yield curve steepen, or maybe we'll see a change to their actions going forward.
Well, in the month of February, when they were coming in, it gets technical very quickly, but when they were buying more of the April 24 security, they're actually forcing a steepening of the curve in that process, because in that 3-year point, there are four reference bonds to the 3-year contract. And by forcibly holding 1 point down, it means that the others need to rise to keep that basket in some kind of rational shape. And so in our kind of estimations, they were actually adding to the acceleration of the sell-off. They learned the error of their ways. They've stopped targeting that. They were lending bonds to people that were short selling them. I mean, some of these things are so overtly stupid. It really kind of gets on my nerves, as you can see. The other thing that was very important here is that, and I don't believe that they've wanted that by any means. I don't think they want to steepen curve low. Just tells us until he's black and blue in the face that they will be in and they'll continue to support things. They want to keep funding levels very low. They want to be very accommodative. That's why they're doing more QE. I think Bill Evans at Westpac is very well regarded, upped his size for a third additional piece of QE. We've been promising investors since they released it in November that they do more, and they'll do a lot more by virtue of the way they go about it. It's not the best way to go about things. And in Australia, the one thing that's very unusual is we have a cash-settled futures contract, which is tremendously unique. But what it does mean is that around contract expiries, if you get the really big momentum funds, global momentum funds come in and invest, if they want to drive the contract to a particular valuation, if they can hold that position to expiry, they get settled in cash. That's incredibly unusual. Normally you get settled in physical securities, of course. So we think that was a big part of the sell-off in February as well, trying to break down the market, trying to force people out that had probably been in from afar. And certainly we heard about that, those kind of stop outs and deleveraging. Now that that's all occurred, things have calmed down a lot and the market's bounced back. It's a bit like a beach ball underwater. You can jam it down for a period, but you can't keep it there indefinitely. And as soon as you stop coming in and forcibly pinning it at a point, it does tend to rise very quickly. And we've certainly seen that in a lot of the other bond market sell-offs over the last little while, that markets like Australia or the European market, they will sell off in sympathy with US Treasuries. But once the Treasury yield starts to slow down and find its feet, those other markets tend to slingshot back fairly quickly. And we've seen that absolutely in Australia over the course of March. So the way that the Australian bond yield versus the US Treasury yield finished February, it ended up marking at about 51 basis points, i.e. Australia being nearly 0.5% yieldier than the US Treasury market. As we sit here today, that is at 7 basis points. So it's come in from 51 to 7. That is Australia massively outperforming as it kind of flies back up like that beach ball underwater that's just going to pop. So that's pretty rational in our opinion. February was relatively irrational, but it still occurred and it causes a lot of volatility and a lot of anxiety at the time. But the other thing that it does do is it makes the go forward really, really attractive thereafter. And we can kind of point to all those historical examples on that third slide to say that is absolutely what has occurred. Of course, it doesn't guarantee that occurs next time out. But if you're a betting, if you're an investor, it's pretty investable. If you're a speculator, it's pretty investable as well. And so certainly, I think the passage of time, is absolutely on side with bonds now that the yields have been reestablished, and those curves have become very steep. And there is a tremendous, powerful tractor beam down that steep curve that does generate a lot of return through time, and we can certainly look at that in terms of looking at the decomposition from the last decade to see that is the majority of the story. And so once that gets on side, it's a very, very powerful concept.
Fantastic. All right. Thanks very much, Charlie. And thanks everyone for joining us this afternoon. We've covered a lot of ground. Hopefully it's been useful for everyone. We will be sending around a copy of the slides and the recording of the presentation as well in the next few days. But please reach out to any of the faces on the screen there if you've got further questions or would like some more information on the funds or markets. I'm certainly looking forward to the 60-page inflation white paper. Hopefully that's available for my Easter weekend reading.
I'll give you a draft, Luke. Just what you need.
Good,
on a nice sunny Easter's Good Friday.
I do need a new door stopper for the office here, so that sounds good. All right, thanks very much, everyone, and look forward to seeing you all soon.
Good on you. Thanks, Luke.